Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video we'll be talking about high growth all-in-one ETFs for a diversified portfolio. It's a specific edition here for our Canadian investors that are interested in low cost investing. But before we get into this video, let's talk about all-in-one ETFs, what they are and what they entail. All right, for those of you who might not be familiar, an all-in-one ETF is actually a bundle of different individual exchange traded funds, or ETFs, being put together that allows you the diversification without having to pick and choose separate exchange traded funds on your own. It actually does take care of that, brings you the more diversification as a result of that. And there are some cases whereby through that exercise you manage to kind of lower your fees. Not always the case, because there are many instances where if you pick and choose the underlying exchange traded funds yourself separately and pick and choose them and then buy them, all of them separately, you might actually end up with a lower fee, but there's a lot more work to do with it. You have to make sure that you rebalance them over time. Say if you want to have certain exposure to a US stock market, a certain percentage to Canadian stock market, and certain others to international markets as well as emerging markets, you have to pick and choose yourself, and over time make sure that the balancing doesn't go out of whack. Whereas an all-in-one ETF does take care of that for you without you having to worry about it, and you just buy into that one ETF without having to worry about pick and choosing separate exchange traded funds. So as a result of that, it does offer that automatic rebalancing and can be bought and sold easily through any popular stock exchange, any other brokerage firm and account that you have. And we have a number of those in the description of the video. If you're interested to open a new investing account, feel free to use those links for any referral bonuses that is currently offered. With that out of the way, let us take a look at different types of ETFs in terms of all-in-one exchange traded funds. There are different ones and types. There are the types that are more geared towards income focused investors, the ones that perhaps are at their retirement age or close to that, so they are more interested into that reliable kind of sources of income coming in. These are mostly having a larger exposure to fixed income or bonds. For instance, you have 90 to 100% of your exposure to bonds. As a result of that, your growth potential is a lot more limited. In many cases, you have little to modest long-term capital growth. The second category is more conservative, and these are the ones that are having a combination of some income and modest long-term capital growth. There is some exposure to income, probably a larger portion of that, closer to, let's say, 40 to 60%, and the remaining balance is actually exposed to equities or stocks. It's almost like a halfway through, 50-50 at some points. Then they have you have more of that balanced approach whereby they contain a little bit more focus on the stocks and equities, say around 70 to 60% stocks, and the remaining balance being exposed to bonds and fixed income. They seek as a result to provide long-term capital growth with a moderate level of income coming in. And last category is actually geared towards growth, whereby you have a larger proportion of focus on long-term capital growth, and typically you have a lot less exposure to fixed income. This could vary anywhere between 80% exposure to stocks and equities, all the way to sometimes even 100%. And the focus of this video, as we introduced it, is on high growth. As a result of that, this is the category that we are going to be taking a look at, and we're going to focus on high growth all-in-one ETFs that gives you between 80 to 100% exposure to stocks and equities, and see how they've done, what are the options for you for Canadian investors, and how you can go about kind of considering different options that you have. We are going to be considering and comparing their fees, their recent returns, as well as their assets under management, and taking a look at specifically what each of one of them entail. Let's get into it. These are the top growth all-in-one ETFs for Canadian investors that you can see. You're able to see the ticker symbol on the left column and other details. What you notice is that there's a lot of similarities in the ticker symbol. So for example, for Vanguard, we have VEQT, which is Vanguard All Equity ETF Portfolio, whereby it holds 4 different Vanguard ETFs, and it gives you 100% exposure to equities. So you're not going to get any exposure to bonds or ETFs, and 100% focusing on stocks. What it does provide in terms of exposure, and this is where I want to really talk about how an all-in-one ETF operates. You see, By buying into this one all-in-one ETF, you're getting automatically exposure about 42% to US total market stock. You get about 30% exposure to Canadian stocks. You get about 20% exposure to developed countries, excluding obviously US and any North American kind of countries. Obviously, Canada and US as a result are excluded. And lastly, you get about 8% exposure to emerging markets. In other words, just by buying into this one ETF, you get exposure to all of those wide range of equities and gives you that really diversified portfolio without having to do a lot of work on your own, just buying into one ETF alone. These ETFs, all of them, as you see, they do pay their distribution or kind of dividend. All of them do pay that on a quarterly basis. The only exception is for the one for Horizon, the Horizon Growth Tri ETF portfolio, as you see, HGRO. Back to VEQT, it does have $1.4 billion assets under management, and it has a management expense ratio or fee of 0.24%. And this fee, which is actually, if you do the math, for a year, if you were to invest $10,000 into VEQT as an example, you would be paying $24 in fee in 1 year. So $24 in 1 year for every $10,000 invested. Not that horrible. It's actually still considered to be very low cost ETF. You'd notice that the fee for all-in-one ETFs are higher compared to, let's say, a typical ETF, let's say VCN or XIC or other such type of ETFs that, let's say, just gives you exposure to US stocks or Canadian stocks, but at the same time are comparable to the fees charged by ETFs that are investing in international. The reason it's higher, the fee is higher, is really for a number of reasons. There's much more rebalancing done here. It actually does take care of that balancing of the portfolio. And of course, you're getting a mixture of different US, Canadian, emerging, international, all in one. Hence, convenience does come with a little bit of a higher price tag. But if you were to buy all of these ETFs separately, let's say all the underlying 4 Vanguard ETFs that are part of VEQT, if you were to buy them on your own, and if you were to do the math, in terms of the fee, it would have probably been a little bit lower, but not by much. Probably the fee would probably be around $15 to $20 in a year compared to $24 that here you're paying. Then you gotta do the math in your head. Is it worth all the time and effort for you to have to worry about and buying into 4 different ETFs and balancing them out in terms of the right weightages and whatnot, and particularly being disciplined, because sometimes one ETF might do better than the others and you might get really tempted to really change the weightage allocated to investments, whereas here VEQT does take care of it for you and takes kind of the emotions out of the investment. So that's something for you to keep in mind. And next, and of course, we want to take a look at the 1-year return. And you see, we have also a 3-year annualized return. This is available for those ETFs that have been around for a longer period of time. For some of them, so for example, for VEQT, the inception date was 29 January 2019. So it's not yet 3 years, hence we don't have annualized 3-year return for that. But the 1-year return here is showing to be 23.85%, which is remarkable. VGRO is another Vanguard ETF. This one actually gives you exposure to 80% equities, stocks, and 20% bonds or fixed income. So it's not 100% equity. As a result of that, you'd see the 1-year return has gone down to 18.19%. It's still remarkable. The management expense ratio is the same as 0.24%, and the assets under management is at $3 billion. This one is Vanguard's Growth ETF portfolio, holding 7 different Vanguard ETFs. The inception date here was 25th of January of 2018. As a result, we have our 3-year annualized return showing to be at 9.96%. Next, we have 2 products from iShares. BlackRock's iShares XEQT, iShares Core Equity ETF portfolio, which holds 4 different iShares ETFs, gives you 100% exposure to equities. And as a result of that, you see you have exposure to US total market about 48%, Canada 25%, international, excluding US or Canada, 22%, and emerging markets, you get exposure about 5%. The inception date here was 9th of August 2018. The distribution is at 1%, and the distribution is actually paid on a quarterly basis. The assets under management is $708 million. The management expense ratio is lower at 0.20%. In other words, every $10,000 invested would cost you $20 in 1 year. In terms of 1-year return, it's showing to be 23.58%. Next, we have XGRO, or iShares Core Growth ETF portfolio, holding 8 different iShares ETFs. Underneath that, it gives you actually 80% exposure to equities versus 20% bonds. And the inception date was 21st of June of 2007. As a result of that, you'd see here we have both 1-year and 3-year annual return. For 1-year return, it's showing to be 18.38%, and our annualized 3-year return is showing to be 10.05%. There is $1.1 billion assets under management for XGRO. Next, we have HGRO, or Horizons Growth Tri-ETF portfolio, with an inception date of 13th of September 2019. The 1-year return is showing to be at 26.23%. It doesn't have the 3-year annual return yet, given the inception date. The management expense ratio is the lowest, showing to be at 0.16%. But also it has roughly the lowest amount of assets under management currently, with only $125 million assets under management. Next, we have ZGRO, or BMO Growth ETF. It holds 9 BMO ETFs as part of it, and has exposure to 80% equities and 20% fixed income, with the inception date of 15th of February 2019. The distribution yield here is at 22.33%. It is paid quarterly, and the assets under management is also at roughly about $125 million. The management expense ratio here is at 0.20%, and the 1-year return is showing to be at 16.69%. Keep in mind that for HGRO was the only one that it does pay its distribution on an annual basis and not on a quarterly basis, and was roughly close to about 1.4% based on the last distribution yield that they had and the price at the time of end of the year of the previous year in 2020. Well, there you have it, folks. A quick look at 6 top growth all-in-one ETFs for Canadian investors that they can consider to buy or watch right now in the stock market. These are wonderful opportunities for investors who want to pursue a passive way of investing without having to have the hassle of picking and choosing stocks and even having to worry about rebalancing their portfolio. The data is as of the time of making this video. I hope you found this video beneficial. And if you gained something of value from this video, I really appreciate it if you can give this video a thumbs up. It really helps us grow the channel, and we appreciate that. And of course, don't forget to subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing in the stock market, as well as other ways of investing and ways to reach financial freedom. Thank you, and I hope to see you next time.